Essentially, by 2040, the population goes from 400,000 New Zealanders over 75 to 800,000 New Zealanders over 75. So massive change in demographic. We're second largest home developer in New Zealand now, so probably wouldn't think retirement village operator second largest home developer in New Zealand. Yeah, anything that can be done to speed stuff up, more time efficient, means we can build more villages faster. Yeah, the massive demographic push, I think you're going to find that there's just not enough retirement village operators in New Zealand in 5-10 years time. And certainly there's going to be not enough care beds in New Zealand, which is actually pretty sad.
Kia ora koutou. Welcome to Shared Lunch, brought to you by Sharesies. I'm Garth Bray, and today we're here in St John's in Auckland at the newest retirement village opened by Summerset. Now, that's one of the 3 big listed operators of retirement villages in New Zealand, and we're here to speak to the CEO, Scoullar. More than 50,000 New Zealanders call a retirement village home, but that is set to rise as our population ages. So what are Somerset's plans to get ahead of that curve? Before I head up to the penthouse to hear, here's some important information you should always consider when investing.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Scott, thanks for having us to the penthouse from the look of it. Where are we right now? What is the spot and what can you tell us about it?
Yeah, so look, we bought this site in St John's probably 2015 now, and so it's been a long journey for us to get to this point where it's open, and it opened late last year. So yeah, it's going to be home to pretty close to 300 residents once it's completed at the moment. So yeah, you're in a penthouse sitting there, pretty much full site. It's got 360-degree view, so it's a lovely, lovely site. Still coming on, but amazing views.
And if you are looking to try to arrive in this kind of place, obviously you're going to have a pretty good financial plan.
Yeah, so look, that's a lovely part about this village. We tried to sort of match like aspiration and make it quite aspirational. So like hopefully when people turn up here, they feel like it's like turning up to a hotel. It feels very formal. It has a look appeal to it. It's got fine dining. It's got cafe. It's got movie theatres, gyms, all the sort of pools, things you can think of. The vast majority of the product probably ranges in about $1.5 to $1.7 million, which is a lot for parts of New Zealand, but like in Auckland, that's actually in this location, it's actually pretty affordable.
So you tend to match whatever offering you make here to whatever local property prices are doing because that's where people are coming from.
Yeah, essentially, like most people come into retirement village within either 2 situations, either within a 5k radius of where they've lived their lives, or typically then they may be taking a choice to move from a completely different location to be closer to family. But you'd find 80% of people would be within 5 kilometres. So you kind of want it to be highly affordable for those people to be able to sell their home, put a little bit of money in the bank, and then come in and use that money to sort of enjoy retirement life. And so most of the time we'd target 90%, 85 to 90% of the median house price in terms of the products that we're building.
It's interesting you mentioned that chain of needing to sell before you come into a place like this, because obviously the market's been a wee bit slow, probably more so than anywhere here in Auckland. How is that showing up?
Yeah, look, I think you're right to pick on the fact that I think people's confidence to be able to sell their house has been quite constrained in the last 12 months. That hasn't really sort of borne out in terms of their desire to come into a village. So we've seen lots of inquiry, like we would have seen more inquiry the last 12 months than we have traditionally previously. So inquiries
Really high. People's commitment to sales contract is really high, but they've been constrained at times by their ability to sell their own home. And so, look, some of that is people take a choice to sort of sit on the fence and wait 3 months, 6 months, but till they feel like they can actually sell their
house. Sometimes we'll work with that resident to give them options to come in. So it might be like we have situations where we allow people to move in early. They can move in whilst they're still selling their home, get settled, which is really lovely for them, and then be out of the house while they're selling it. And so, at times we'll give them 6 months to do that, and that gives them the confidence to sort of say, right, I'm prepared to give that a go and sell my house. And look, at the end of that 6 months period, if they still hadn't sold their house, we'd work with them. It's not like they're going to get kicked out on the street. Like we want them to be living life here. And so you're just constantly working with people in their individual situations to figure out how you can help facilitate them coming in. And that's been the hard bit with the economy in the last sort of 6 to 12 months. It's not, as I said, that people's desire to come in has changed. It's actually just helping them sort of make that transition.
Those terms, are they kind of a new response to the conditions, or is that something you've gone to before in other times where things are tricky? Because you've been around for a while, right, as a company?
Look, it's a good question. Most of them are things that you've used in the past. So like, during COVID, 2020, it was the same sort of environment, right? People were predicting housing market was going to be terrible. And to be honest, it wasn't actually as bad as people predicted. But, it's those same types of tools that you pull out that just facilitate people to come into a village.
I guess if you can tell me a bit more about Somerset particularly, like what would I see here that I wouldn't see at another retirement village operator's place?
Yeah, look, there's a few parts, I think, like in terms of what we're proud of. Like the first one is we sort of pride ourselves that you come and live in a village where it's actually your home. So we treat it as residents' homes. So like when our staff are here, they're very mindful of this is actually people's homes that they're sort of working within. I think potentially that could be a different philosophy from other operators where it's sort of more like this is our village, you're coming to live with us. So, pretty much we stay in the background, facilitate it as much as we can, but almost try and be an extended member of their family to help out and stuff. And so I think service, like residents love their lives in our villages. 97% of our residents are satisfied living in a Somerset village. So we're really, really proud of that. The second thing is we build in a lot of broadacre locations. So, I think a lot of Kiwis have grown up with the 600 square metre section, the grass. That's something we like and enjoy building. So, you'll see us in broadacre situations right throughout New Zealand. So we're probably the most geographically diverse of any operator throughout New Zealand, and we like to build homes that people can actually enjoy a bit of green space. Obviously, when you come to a special place like this, you can't actually do that because you can't get enough land. But
we're in a bit of a vertical village, by the way.
Yeah, we are in a vertical village, and we sort of only build one of those probably at any particular point in time. But most of the time, it's broadacre villages, and the bit I love about that is it's people have got access to outdoor living, pocket parks, like barbecue areas, you name it, like mini golf driving ranges, like it's non-stop sort of ability for them to access things. And so whether it be vegetable gardens, there's something there for everyone, and people's ability to then jump out of their home, out the back door, and kind of have their own little patio area and stuff they can enjoy, and their own little grass patch they can enjoy is quite special. So yeah, I think like there's a couple of things there, like and I think probably the third thing I'd say is in care, like we have integrated villages with care access on site, and with that's pretty typical for New Zealand. Look, it's quite different for Australia, so we are quite different in Australia on that regard. But in New Zealand, like care, we try and produce quite small private homely care environments. So because when people are going through the later part of their life and they need some care and support, I know we feel like it's really important that they feel that that's an environment they're sort of safe, comfortable, and it's private. They have the same nurse every day, they have the same caregiver every day, rather than a large hospital environment where each day you might be experiencing a different person looking after you, or you've got no privacy in the lounge because there's 40 other people in there. So small private care facilities combined with broadacre living, combined with that sort of like lovely sort of service environment that we create, I think is kind of the three things that are probably the most important to Somerset.
All right. How's that working for the financials? Can you walk us through the numbers? I know you've filed your half year pretty recently, so they'll all be fresh, I'm sure.
Yeah. Look, last year, so we delivered an underlying profit result of $206 million. That was up 8%. And to be honest, up 8% in what I'd probably, in my working career anyway, it's probably the hardest year I've experienced. And so for us to deliver a result up 8% we feel is pretty credible, and I think at the same time balancing that with the 97% customer satisfaction, and for our staff who are working for us as well, making sure that they are still engaged. And so we scored 8.1 out of 10 in our engagement surveys, which puts us in the top quartile of healthcare providers around the world. Getting that mix of sort of financial performance with good staff satisfaction, with engaged residents enjoying their lives living in our villages, that sort of trifecta of things is really, really important to us. But on the profit side of things, that was really driven by the popularity. So we talked before about people's struggles coming into our villages, but if you actually look underneath the profit results, new sales were up about 5%. Resales, that's homes that people previously lived in, they were up 20%. So, the core sales for the company was still up 12%, which was in a pretty dire property market. So that was sort of the genesis of the profit performance. At the same time, we were being pretty careful and cautious about making sure that we managed spend. Operating costs out there are pretty crazy for New Zealanders in general, but it's the same thing for retirement village operators. Doesn't matter whether it's rates, insurance, trying to constrain some of those costs as well at the same time as making sure that we deliver that great experience is sort of key for us.
Yeah. I'm just sort of looking around. I guess we've seen two of your competitors effectively go into private equity. Another one's sort of, if we're frank, struggling a wee bit with an equity raise that's just finished. Are you still ruling out the need for that kind of capital raise?
Yeah, look, for our growth plans at the moment, we don't need to raise capital. Essentially, the way our sort of development cycle works may be a little bit different to some of the other operators. So when we build a broadacre site, essentially, it might cost us, just say, $150 million to build that site. By the time what our aim is, so when we buy a piece of land, our aim is essentially to get all that money back through the first sale of those homes in that villages. So we won't purchase a bit of land and start construction if we don't think we can recycle our money out after we've basically built a village and sold it down for the first time. And so we don't, as a business, have any core debt that sits there. All our debt is essentially land, working capital for building villages that are half complete, and then stock that we own just as we're going to sell it down. So if you think about that, like if we were, worst case scenario to shut the doors and say we're not going to build any more homes, the company would have no sort of core debt. Whereas I think, probably and that we feel is a bit of a differentiator for us. And so we can essentially go as fast as we like, as long as we're sort of keeping in mind that we want our number one ambition is to sort of recycle that capital back out of each project.
You don't feel extra pressure to sort of step it up a little bit and maybe leverage a little bit more and go and grow a little quicker?
No, I think there's always a challenge there about, can you build faster? Should we build faster in New Zealand? Should we build faster in Australia? I think as a business, we've just got to do the right thing for the company at that particular point in time in the cycle. So, we give 12 months guidance on build rates, but we're not afraid to slow that down. So last year, in the first part of the year, we came out and said, hey, economy's not so good, property market's a bit harder, we're going to build 50 less homes, and it's much the same during better times. We would do the same thing. We'd sit there and say, hey, we can't get enough product and people are queuing up at the door, let's actually build some more homes in each village. And so it's about kind of keeping the company really sound and financially sort of stable for the conditions that you're trading within. And so we're very, very mindful of that. And we meet and have conversations as a leadership team about things like build rates every 6 weeks. So that's us just constantly sitting there and saying, what's the economy doing? What's property market doing? What's house sales like in each one of our villages? And just applying focus to that constantly. So yeah, there's always pressure there. As a leadership team, we're pretty competitive. Want to build more, want to generate a better return for shareholders, but at the same time, as I said, you've got to be careful around making sure that the balance sheet's always strong as well.
I just can't help thinking about the announcements this week around development contributions and around shaking up the RMA.
Yep.
Widely spoken about as good news for people who like building things. You people who like building things, is it good news?
Look, couple of things there. Development contributions are pretty burdensome for large operators. If you think about the infrastructure for this village and everything we do in this village, people probably don't have a lot of need to kind of access other services throughout Auckland, which was often what you're paying for with those development contributions. But and look, probably a little bit sceptical around some of the changes and freeing stuff up and making it better. We've seen the fast track process, which we've used probably now since COVID. There was some legislative fast track process to build big projects. And to be honest, that fast track project process is almost at the point now where it's slower than the slow track process. And so, it's interesting in that I think sometimes you can see these good intentions come in, but they need to actually practically work. And so, yeah, the magic in this, and that will be actually how they actually operationalise that in a way that actually practically works, I think. So we're sitting on the sidelines and sort of just wait really.
I guess, I mean, you're a nationwide builder, so the idea that they're potentially going to simplify things so that there's more uniform codes around construction just makes a bit more sense for you.
Yeah, look, love the theory behind it. And, like we're second largest home developer in New Zealand now, so you probably wouldn't think of a retirement village operator as second largest home developer in New Zealand. So, anything that can be done to speed stuff up, essentially, is a better use of capital for us. More time efficient means we can build more villages faster. It is just in the practicality of with which, they implement this stuff.
You don't acquire other properties then, really, do you? You don't go into an existing operator and say, we'll have
Not
you,
typically.
we'll take you on. What is that, a conscious choice? That's just not part of how you operate?
Pretty conscious choice. Like the only time we've done that is in Nelson. We bought a village that the first 10, 20 homes have been built already by another operator, and then went and bought that off them. But typically, if you come back to that sort of conversation before about the business model, and essentially what we're doing is building those homes and recycling our money back out of it via selling them down. If you have to go pay another operator who's already built a village to purchase their village, you can't recycle your money back out of that. And so you would have to keep going to shareholders and saying, hey, I want to go buy these great set of retirement villages, but we need some more money for you to do that. And so when you look at the merits of that versus organic growth is way more efficient. It generates a better return because the investor hasn't had to put any more money in. Our preference most of the time is to build.
Provided you can get the land.
Yes, but to be fair on that, we've got 7,000 homes in our land bank, and so if you think of us as a business, we've got 7,000 homes built. So like our land bank enables us to double in size, and if you think about through the worst part of the economic cycle, last year we were building 700 homes. 700 homes, you got 10 years worth of build supply if you kept at that level, but in 10 years' time, the size of the company is going to double. The value of the company is going to double, and hopefully the share price for the shareholders will double as well. So,
it's doubled twice in the time that you've been with the company, either as CFO and CEO. Is that about right? I think
when I joined, it was $2.80. Yeah, so it's probably
thinking,
4 times.
Yeah, in terms of assets, I think it's.
There's no reason why that shouldn't continue, because if you think about, you're building these assets, and effectively they're sort of free assets once you've sold them down. The NTA of the company goes up, and if you track, the NTA of a company relative to our share price, it's a pretty sort of consistent track. So, if at the moment the share price is $12, one would like to believe and hope that if the company's twice as big in 2 years' time, maybe the share price might be more double that, and it might be $24 rather than $12. But, that's if you sort of said if you track over the last 12 years, that's the sort of history of what the company's been on. So that's the goal that we're chasing.
Is that achievable just with the kind of organic growth you're talking about here in New Zealand with the sites that you've bought most recently, or are you looking increasingly that you are going to have to make good on the talk of development, taking those aggressive opportunities perhaps, or high growth opportunities in Australia?
Yeah, look, we're pretty comfortable. I think, doubling the size of the company in 10 years isn't a bad thing. For a company our size anyway, it's probably not a bad thing. I don't want to sound complacent, but I think during the better times in the property market in New Zealand, you might have ambitions to build exponentially faster in New Zealand. So we've got the land bank to do that, and it's pretty well consented. So, we don't have a lot of barriers to stop us building faster because we're broadacre developers. We've got 15 villages we're building at any particular point in time. If you chose to build 10 more homes on each village, because your demand's really high, all of a sudden you can lift the build rate by 150 homes. That's quite material, right? That's a 20% lift in build rate in New Zealand. And then if you think about our journey in Australia, we've got 7 bits of land there now, and opened our first village last year, opened our second village at the end of this year, opened our third village the year after. That's going to become quite a progressive growth journey for us. And so again, 5 of those sites are consented now. So that will quite meaningfully become a contributor to our aggregate build rate in quite a material way. So last year we only built 10 homes, but in 3, 4, 5 years' time we'll be building 200-300 homes from Australia. And so you start taking sort of those and aggregating them together, and not only is there sort of growth, but there's probably quite a large level of exponential growth that's an opportunity for us as well.
I suppose we better talk about the demand side of all of that. We're all getting older, all of us, apparently.
Yeah.
Are we still on track, to sort of hit, I think, something like 1 million people over 75 by when? 20, 30, 40 years?
Yeah, look, essentially by 2040, the population goes from 400,000 New Zealanders over 75 to 800,000 New Zealanders over 75. So massive change in the demographic. And I think even by 2030, the number of 85-year-olds goes up by 125,000. And so, like, it's pretty quick. Like, it's pretty close by. Now, if you think in the next 5 years, 125,000 extra people, like we need something like 13,000 extra care beds in this country just to cope with that demand in the next 5 years.
So we're getting older, but the stats would also tell us that an increasing number of people work past 65, which is the point where you'd retire, and lots of people want to stay in their own homes. So where's the evidence, I suppose, that there is a really big wave of people that would be looking for the kind of opportunity that's offered in a place like a Somerset retirement village?
Look, I've been in the company for probably 12 years now, and it's interesting, like you sort of see as change in medication, advancements in medicine in terms of people, the way they live their life sort of has changed quite a bit in the last 10, 12 years. But for us, like if you sort of correlate to the average entry age, it's probably lifted up about 1 or 2 years at the same time. So there's definitely a drift as people live their life and live it in healthy conditions, healthy state, that they probably take a choice to come in maybe slightly later. But it's not like, I don't think you see a massive trend of like people suddenly coming into retirement villages sort of 10 years later than what they previously did. It's a very slow sort of drift. And if you kind of come back to the sort of reasons why people come in, it's often safety, security, mum's struggling to get up the stairs anymore, dad doesn't want to mow the lawns. Those things still happen in your life at a certain point in time. It's just, is it 79 or is it 81? And so I don't think there's going to be a massive philosophical change to the age when people enter into villages. And if you look at that, just the sheer numbers of that demographic stuff, like it's literally going to double in the next 15 years. Right. Like even if you get a small drift, the massive demographic push, I think you're going to find that there's just not enough retirement village operators in New Zealand in 5-10 years time.
Wow. And
certainly there's going to be not enough care beds in New Zealand, which is actually pretty sad.
So Scott, you were the CFO, you become the CEO. Bit of a switch?
Yeah, look, it is quite different. My exec team would tease me about at times. You've gone from being a no man, which is being the CFO role, and going to be a yes man and the CFO and the CEO role, I should say. But it's different. I think in the CEO role, you're trying to balance off expectations of residents, and you're trying to make their environment lovely and enjoyable. And they're our biggest advocates out there. You're trying to make sure staff actually really enjoy working for the company and feel like they're actually doing some good. And at the same time, you're trying to bounce off that shareholder expectations. So you're trying to get that balance right. And at times I spend a lot of my time going out to villages talking to residents, and you're almost like, rather than being CEO, you're the chief customer advocate for the organisation, and that's really enjoyable. Like, it's a real privilege to be able to do that for the organisation at times. But it's certainly different from being CFO.
Does it leave any time at all for you to tinker away with your vintage cars, or your classic cars, I should add, rather?
Look, I have less classic cars now than I did because my son's racing and doing motorsport, so I had to sell a couple of my cars to pay for his race car. But I do have a 67 Mustang, which it's been with me for probably 25 years. My wife would probably tease me and say I love it more than I do my family. That is not right. But it's part of the family.
Fantastic. Hey, it's been lovely spending some time with you. Thanks very much.
Cool. Thanks, mate.
Thanks for watching and for listening. I'm excited. It looks like it's Scott's shout. I finally get that shared lunch. Ko matu.